Good afternoon and welcome to our cash flow forecasts webinar. This is a session for absolute beginners. It does not require any prior knowledge of how to do a cash flow. We've put this webinar on because we've been speaking to a lot of business owners recently, and when we've asked them about their cash flow, they don't know how to do one. So they haven't got one because they don't know how to do it. So what I've decided is that since I have a background in finance, that I would put this on. I am a chartered accountant. I'm now working as a business coach, and I have been working as I've been working with small businesses for the last 30 years in finance. So I do have a lot of experience in how to draw up a cash flow and how to manage your finances. So what we're going to cover today is a way of managing your cash, why we want to manage it, a basic cash flow preparation, what complications can arise when we're building a cash flow. Then we're going to cover building up your cash reserves, and then we're going to have a brief look at what your next steps are. There is space throughout of this for Q&As. If you'd like to pop any questions in the answer box, please do. We will get to them as we can. Thank you. So what is a cash flow? So a cash flow forecast is a way of managing your cash. It's quite simply a statement of what you have in the bank now, what cash you need to spend, and what cash you have coming in. We spread it over the future time periods so you can see what the time is like where you're going to run out of money. So are you going to run out in a month or 2 months, or actually have you got enough to keep you going, or have you got enough to invest in something, and if you need to borrow short term to invest in a project that comes up. So it's very important that you have this because you can make decisions a lot quicker if you know what cash you've got. It ultimately also tells you how viable your business is. So if your cash is just going out and out and out, you will find that your business is not viable. A lot of businesses have gone out of business because they couldn't pay a very vital bill and they couldn't get credit. So let's go straight into a very, very simple example. As you can see, this is an example over 11 weeks. I've started with £3,000. We have payments going out of £400. And because of the crisis that we're in at the moment, our income has fallen to £100 a week. So we have a net outflow of £300. And as you can see, this statement will show you how much you've got in the bank at each time. So we start with 3,000, we take off 400, we add back on 100, we get to 2,700. We start again with 2,700, we take off 4, add on 100, and we continue going through that. And as you can see, the £3,000 will last for 10 weeks. And microphone. As you can see, that is basic maths. So the £3,000 divided over the £300 of net income, you can tell that that will going to last for 10 weeks. So how do we prepare this? So the first thing that we do is we find out what we've got in the bank today. So this is everything you have in the bank. So you might have various bank accounts, you might have deposit accounts, and especially some people really find it useful to put aside money for their VAT or for their tax bill, or something that's not going out every month but going out quarterly or even annually. So include all of your bank accounts and then adjust as necessary. So what this means is if you know that there's a payment that has gone out but it hasn't actually been reflected in your bank account, then you need to adjust for it here. The second thing we do is we list all our outgoings. So for what we need to know is how often we're going to be making that payment. Is it going to be daily, weekly, monthly, quarterly, or annually? So a daily payment might be something like your bus fare. It might be your coffee as you walk into work, although you're not doing that at the moment. But it's something that you pick up daily. A weekly is if you're maybe paying somebody weekly to do something for you. And then monthly, maybe your salaries, it may be your rent. Quarterly, again, it may be rent, it may be some sort of training meeting that you have quarterly, and then annually is likely to be something like your corporation tax or your tax in general. And quarterly, again, could be your VAT. We then need to know what date you think you're going to next have to pay that amount, the amount, which is very important, the who you're going to pay it to, and the how. So the how is whether it's going to be going out in direct debit or whether you have some control over who you pay and what date you pay that person. And then the category is here for you to make this simple. So we're going to categorize all our income into different parts of our business. So usually along the lines of your management accounts. So that could be wages, it could be marketing, it could be telephones, anything stationery, anything that you have in your business. And that's because what we don't want in our cash flow is a whole long list of items that are going to be paid out, because that just becomes unmanageable. So we only really want 10, 15 lines at the very most. So we choose our categories. We then do exactly the same with our incomes. How often do we think this money is coming in? What date we think we're next going to get it? The total amount that we're going to get in, who is going to pay us, and whether or not it's paid by direct debit. We have a Go Cardless account or something like that set up, or whether we have to wait for them to pay us. And again, the category. If you only have one source of income, you may only have one category. If you have multiple sources of income, then split them out, because it'll be easier for you to see and to manage what's coming in and how. This, if you are a VAT registered company, then it is easier to do this with VAT on. So add the total amount that's going to come in, because obviously you're getting the cash in from your customers with VAT on. You're paying stuff out with VAT on, and then we have to pay the VAT bill halfway through. So the next thing is that we organize all this by category and by frequency. So we say what was going to happen when, and I'm just going to switch to Excel to show you a very simple example of how this will look in real life. So here we have the chart of which we're going to populate with our expenses. So as you can see, I have split that out weekly, monthly, quarterly, and annually. So we've got various things down the side in our categories. As I said, we don't want to we don't want to make that too long, but it needs to be a little bit meaningful so that you can understand and work through it. And if we go down a little bit, you can see that I've populated those columns with the amounts we've got in. So every week we are expecting to pay out £5,000 on materials, 300 on marketing, and that might be Facebook ads or something like that. Printing stationery, we might be sending goods out to our customers, office expenses. So you can see that there. And then obviously we've got things in there for monthly. We've got our staffing expenses and our rent. We've got more marketing, legal and professional. As you can see it happening there. And quarterly, we can see we have our training. I've put in here a training budget so that every quarter we can do something with our staff. The other is an annual other thing. It could be the corporation tax amount. Again, just put some trial figures in here so that you can see how the principle works. We then do exactly the same with our income. I've put some general income categories there. Retainers, you might get service, different services that you offer or different goods you offer, and then some other income. And I have populated that just to make it make sense. And you can see that I have tried to make sure that this company does make a profit at the moment, so that their total income is slightly higher than their total expenses. The columns at the end, the annual total and the monthly expenses, just there for sanity's sake, really. The annual total will add up 52 weeks, 12 months, 4 quarters, one annual, to give you the total amount for your business, because this is something that will just make it's just a sense check, really, because you know your own business and you'll be able to look at that and think, there's no way I've made a mistake. So that's what that last column is. Then what we do with these two is quite simply to put them into a bigger spreadsheet. So what you can see I've done here is I've got weeks 1 to 13, so I've got a quarter here, and then I've inserted months 1, 2, and 3, and I've put quarter 1 at the end. And I've also put in a little column at the end to save us for annual, just so that we have some sense of what's going on. We can move these things around. Now, you might look at this and say, do you know what? It's not even. It's on average, we get £5,000 a week for materials, but it doesn't happen in this lovely, neat way. So you can then start playing with this. You can then start populating it the way your business runs and how you like to see it. Likewise, I've put that the monthly figures are in there. Now, it may be that your staff get paid at the end of the month, so that's fine in that column, but your rent might get paid in week 2. So you might want to move that figure across. So all we're doing here is giving you a framework to start your cash flow. You then look at it and say, does that make sense? And all the way through this, it's, does that make sense? When I'm looking at my business, I know my business, does it make sense that this is happening in this way? And it may sometimes seem like we have to have a crystal ball to do all this, but actually you know your businesses. And yes, you can't be certain that that's going to come in, but you've got a good idea. And if you think it may or may not come in this quarter, then you can sort of make a decision whether to put that in. When we have done put our expenses in, and when we have put our income in, we can then put our opening balance, which is this figure down here, opening balance at the beginning of week 1. Then it takes away the expenses that we have paid, adds the income in, and it gives us a figure to pull forward into the next week. And as you can see, this just rolls through. So the opening balance the closing balance from last week becomes the opening balance from this week. And then the closing balance from this week will become the opening balance for next week. You can see, I've put a little graph in there just so that you can see that the money goes up and down. And the money has a big dip here in month when we put the months in the columns. And that's because I've assumed that everything that goes out monthly goes out at the end of the month. And that will not be true necessarily in your business. But again, you know your business, so you can move these around. One thing I would say is that it is good to have at least 3 cash flows, or at least prepare at least 3 cash flows. So you have one where you can take out all of the income, or you can have a worst case scenario in that your income is going to fall off a cliff because you're all at home, but you still have to pay your suppliers. You can have a best case in that it's business as usual and we manage to continue or even increase our sales in that time. Or you can have sort of like this makes more sense, one in the middle where you just apply common sense and say, yes, I think we a little bit optimistic, but not too bad. So that is how to prepare a cash flow. Hopefully not too quickly. We have a couple of questions in now. Yes, I will be. So the first question is whether or not we will be giving you access to this spreadsheet. And yes, if you would like it, just put a note in the question and I will send it to you. The recording will be available on our website in a couple of days, so you'll have that as well. And I think I've answered the question about uncertainty. Maybe not. So it is always uncertain what we're going to put in. It is only our best guess. So please, don't think you have to get this 100% right. When we look into the past, as we are in our profit and loss account or in our balance sheet, it does need to be 100% right. But when we look into the future, nobody is going to expect you to get it right. You just have to do your best. It's just a best guess of what you think is coming round the corner. And that's why, as I said earlier, that it is a good idea to have 3 of these. Okay, let me go back to the presentation. So what complications can arise when we're doing cash flow forecasts? As I said, this is a very, very simple way of doing cash flow forecasts. So if your business is very much more complicated, it may not fit. But let's just just run with it. If it's the first time of you doing cash flow forecasts, start this way, and then you can add complications in later on. One of the things that might happen is multiple bank accounts. We spoke at those right at the beginning. Do include multiple bank accounts. If you've got them, every source of income is what you need to be putting in here. As I said, we have uncertainty on the cash flow forecast. We don't know what's going to happen tomorrow. We are hoping that somebody will pay us. They may not. We think we've got to pay this out, but maybe we might be able to leave it until another week. Things like salaries and rent are almost fixed if you're not paying an awful lot of overtime or wages per the hour. Then if you've got salary that's fixed per month and you've got a rent, those sort of things tend to be more or less certain that you will be paying those out. But other things such as materials, Facebook ads, all of these things, we just don't know. We just have to take a best guess. Different businesses. So if you've got 3 or 4 different businesses, or even 3 or 4 different departments in your business that are completely different to each other and operate differently from each other, then do different cash flows for them, and then we can combine them all at the end. Just because that will give you much more information about how that part of that business or that department is working as a whole, because otherwise that information will get lost when you combine all of the information. So then we're going to look at building up our reserves. Now, why we might need that? Well, we're going into a period of uncertainty at the moment. We don't know what's going to happen. So maybe the cash in our bank account is better than the cash in somebody else's bank account. The first thing we can do is look to our own business to build up those reserves. So we are looking internally. So those are the people that owe you money, so your debtors. Can you get them to pay up early, or do you have to make arrangements with them? But the best thing to do is to talk to them. So make sure you're always talking to your debtors about when they are going to pay you. You may have unused stock on your shelves. If it's been sitting there for a while and isn't going to move, then the best thing you can do is sort of have a yard sale and try and get rid of it. Maybe go on eBay or something and just do an Amazon shop, anything, just sort of try and move it on. If it's stock at the moment that is perishable and it's not going to last past the crisis, then it's a time to start thinking, well, how can I use that really quickly to convert it into cash? And our creditors, now, quite often people pay a bill as soon as it comes. Other people will wait to the full terms, or in fact will wait until that person chases them for it. So if you are one of the people that pays as soon as the bill comes in, consider delaying that payment so the cash is in your bank account for a little bit longer. And what this will do is it gives you a little bit more flexibility with your cash flow. If you don't like that idea because you feel you're going to spend the money and it's really important that you pay this person, then perhaps move that cash into a deposit account so that you've got it somewhere, and then you can pay them when their term is up, but that you're not actually losing control over that cash completely. Once you've exhausted everything within your business, you can then look outside your business for cash reserve building. So that will be something like loans. So you might want to go and see the banks. You might want to look in family and friends. They might have some money that they can borrow, lend you, that you can borrow from them. I'm not a big fan of lending within families because it can lead to, especially if the business doesn't survive. But if they are committed to your success, then they may well want to help you out of this short-term issue that you're in. Overdrafts, go and talk to your bank about extending your overdrafts. At the moment, the banks are being very, very kind to people with their overdrafts. Credit cards. Credit cards are a great source of short-term finance, but not long-term finance. So if you are going to need some money for maybe a week to 6 weeks, then a credit card is a really good way of using your limit and getting that loan, and then you can pay it off as soon as the bill comes in. If you are going to have a long-term loan or a long-term cash need, credit cards are probably the most expensive form of borrowing you can get. And then at the moment, we've got a lot of government assistance. So that's things like the loans, the staff retention schemes, and the rate rebates. So if you don't know what the government assistance is, go and have a look on their website, the gov.co. There is, gov.uk. There is some information about that on our website. We are keeping that up to date as quickly as we can, although things are changing quite a lot with what they do. Are there any questions about building up your reserves? What to do if debtors don't pay you? Okay, well, if debtors aren't going to pay you, you need to be on this straight away. You need to be monitoring your customers and their payments to you. And you need to be asking for the money at all times. If you've got a very good debtor management system in place, then it is less likely that people won't pay you. So that's things like sending a reminder the day before the invoice is due, ringing somebody up just casually, just to let you know the invoice is due tomorrow. Is that going to be a problem? Or even a week before, just to let you know that your invoice is due in a week's time. And then if as soon as the invoice is late, somebody rings up again and says, your invoice is late. I know a lot of people have a problem with credit control and ringing their customers to ask for money. If it really is something you don't want to do, then get somebody else to do, because it is really vital for your business that you're doing this. If they don't pay, you may be looking at solicitors' letters, or even court, going to court for it, depending on the value of your debt. So just keep it in mind. And you really do not want to be working for people who are not going to be paying you. Okay. So what's next? So what's next is I would like you to get in touch with me for your pro bono coaching call. And we can talk through your own crisis plan at the moment. The Calendly link is on the screen. You could also call me if I'm around. I will talk to you or arrange a date to talk to you. And also, once you've got your cash flow in place, it would be great for you to join us for a 90-day planning session where you can work out what is going forward. But the first thing you really need to do is to get yourself a plan. Get yourself a cash flow so that you can see where your cash is going. Does anybody need help with that? If you do, just let me know. Wonderful. So that's the end of our webinar today. If you do have any queries, then please let me know. If you would like to take up this offer, please do. And I look forward to talking to you and walking through your cash flow and your plans in the future. Thank you very much.